This episode of Tech Solutions for CUs is brought to you by Model Shop. Model Shop leverages artificial intelligence and alternative data to optimize member decisions in real time. By combining traditional credit data and risk models with non-traditional data points, such as banking transaction histories, Model Shop's decision engine provides unparalleled insights into consumer creditworthiness, utilizing cash flow underwriting, which enables credit unions to make more automated, personalized, and inclusive lending decisions with a higher level of approvals.
And now here's the host of Tech Solutions for CUs, Finnipotamus publisher John Sanfilippo.
Credit unions have always placed an emphasis on financial inclusion. In fact, that's why credit unions were created, to give common folk access to financial services that banks weren't willing to offer them. Yet it's always been a challenge. How do you effectively manage risk while serving as many members of the community as possible? A big part of the answer today is artificial intelligence. Coupled with the right data, AI can help your credit union achieve some amazing things. One company that can help you make sense of it all is Model Shop. We're lucky to have with us today on Tech Solutions for CUs, Model Shop's CEO, Tom Tobin. Tom is here today to do a bit of a deep dive into Model Shop's new white paper called Innovation and Inclusion in AI Credit Risk. Let's see what Tom has to say. Thanks for being here today, Tom. I'm very excited to talk with you. I know there's a lot going on at Model Shop. We've got your new white paper, which we're here to talk about today, called Innovation and Inclusion in AI Credit Risk Models. And then in July, you and I are going to be on the main stage at the World Credit Union Conference in Boston with Chris Hamilton from Golden One talking about some of this stuff. So I'm very excited about that. So welcome.
Thank you, John. Really happy to be here.
So let's maybe set the context for this whole discussion by first talking about the Navy Fed situation. As we all know, Navy Fed was in the news late last year for not good reasons, based on an analysis of publicly available records. It was determined that their mortgage underwriting was showing some racial bias, which of course was not intentional. But everything I've read about since then about that says basically the same thing, and that is, yeah, Navy Fed got picked on because they were big, but this is a system-wide problem with the way we do underwriting and the way we've done underwriting for decades. Do you want to maybe comment on that?
Yeah, sure. And it's absolutely unintentional. It's sort of funny when you watch it on the news. It sounds like sort of the evil financial institution picking on the small people, and that that's not the way it works. It's really based on statistical models. It's odd that the way that we make credit decisions really hasn't changed that much in 20 or so years. It's primarily based on propensity to pay scores driven by FICO, Experian, of the other vendors, or custom models that lenders have made, and then pretty rough buckets where you place your applicants in, and based on financial ratios. So it's a very blunt instrument, and I think applicants who don't have traditional financial backgrounds or portfolios, potential new emerging credit users, immigrants, they're going to be discriminated against unintentionally based on the way the statistical models are built.
So you mentioned that we've been doing it the same way for 20 years. I assume 20 years ago we were doing the best we possibly could with what we had to work with, but that's no longer the case, correct?
Yeah, there are definitely opportunities to use technology and data to make better decisions. I would say 20 years ago, the distribution of the population was maybe a little more normalized. We're now seeing new generations that think about finance differently. We're looking at more diverse demographics and populations. So the way those traditional splits were made are really becoming stale.
For all the people that are used to doing things the old way, the 20-year-old way, uh, we're here because there's new technology available, and so what's different now? What can happen now that couldn't happen before?
Yeah, so the next generation of credit decision models, they're really not just models. They're decision engines, intelligent engines that can look at different types of data and understand an applicant's complete financial picture. So, instead of the traditional way of splitting based on some scoring technology and some financial ratio buckets, the newer models are able to look for events in your history. So, for example, insufficient funds in your banking transaction history that could either be pulled from your core for existing members or through some of the open banking data exchanges. But more importantly, these models can feed those types of indicators into predictive analytics, but also do time-based analysis. So, if you can look at someone's financial situation and how it's evolving over time, it gives you a much better picture of how they might perform in the future.
That makes sense. So the title of the white paper itself talks about inclusion, and of course, inclusion has always been a central theme for credit unions. In fact, that's why credit unions were started, to include the people that weren't being included. But now it seems like maybe the technology is catching up with the desire for inclusion. Would you agree with that?
Yeah, I think the newer tools and the new alternative data gives you a lot more options in how you assess risk. And you can think of a couple of examples. So let's say a new grad who doesn't have a lot of financial support as they went through college, and they're making their way in the world, but are also very fiscally responsible. On a traditional credit report, they may not look great. They don't have a long credit history. Their debt ratios may be high, driven by high student loans. But at the same time, they're paying their rent on time, their salary is increasing regularly, they're fiscally responsible. You can compare that to, maybe a different applicant that has been given a lot over the years, right? They really, left college with no debt, they got a high-paying job, but currently are not very fiscally responsible. The traditional models and scores will favor the person who had more advantages in their history, right? They didn't have to build up loans. They may have gotten into a job and an education that got them at a higher initial income. The newer models, by looking at your banking data, looking at other sources of income, finding things like potentially payday loans that someone might be taking out that are off the bureau books, you can get a much more balanced financial picture, and then you can make a more equitable decision.
Okay. So then really it's not really about making more loans, it's making the right loans.
It's making the right loans, making fair loans. And by the way, some of these new techniques are much more explainable from a compliance perspective. That if you can model cash flows, for example, it's very easy to prove that that's a non-biased feature of someone's financial performance, as opposed to putting them in a financial ratio bucket, which could be an indicator of, could be correlated with some, unintentional demographics, for example. But it is also about, for credit unions, what we're hearing working, with our clients is it's also about bringing on more members, serving more members. So accessing a larger portion of the market, in particular, next generation members, where the average age of members, I think, is 47 or something like that today. And I know that a lot of credit unions are looking to bring in some younger members. And these tools make it easier, right? It gives you the ability to look at information that doesn't purely come from their credit bureau. It allows you to understand how fiscally responsible they are, where they are in their stage of their financial career, and then make the right offer, make a more personalized offer that makes sense for that potential new member.
And also equally important is the fact that these decisions can be made lightning fast so they can keep up with the digital world, correct?
So yeah, the new decision technology really does more than make smarter decisions. It can reduce friction from the process. So the ability to go out and pull new data sources and make it feel like you understand the applicant and you have access to their history, especially if they're existing members, can make it much easier to get a loan. It allows you to get it to complete a loan in one sitting, and it's more competitive to some of these fintechs and other types of lending providers that are focused on that frictionless experience.
So maybe let's talk a little bit about cost benefit, because obviously no technology is free. So maybe explain that a little bit.
Yeah, so obviously, higher performing loans, credit that you issue, it has a positive financial impact. It can be substantial. We've been working with quote unquote alternate data for almost a decade now, mostly in the subprime space. So we worked with a subprime auto lender 10 years ago. They actually had to upload banking transaction files and scan them, which was accepted in subprime. But they were doing very interesting analysis with that data, doing cash flow analysis, understanding propensity to pay and the probability of default in a time-based manner, which was pretty unusual at the time. They were actually hand doing this with spreadsheets originally, and we were able to help them automate that, which made them much more competitive. So that company grew 25% volume year over year for a number of years. They're really a innovative leader in that space. We've also seen we've been working with a branch lender that has been using Plaid to analyze for personal loans, analyze data for personal loans.
Mm-hmm.
And by looking at their historic banking transactions, they've been able to reduce first payment defaults by 30%. And that's substantial. And we were really surprised in some of the features that really helped drive that. We thought it would really be about cash flows and insufficient fund transactions. And one of the biggest indicators was off-bureau lending relationships. So, looking at buy now, pay later, or payday loans, or things that don't necessarily make it into the credit report.
Mm-hmm.
So it gives you this full picture of the financial risk and the financial health of the applicant.
So I guess this kind of goes back to inclusion. Does this mean that subprime and near prime is maybe a more attractive space for a lender now that they have these tools?
I don't think necessarily. I think these tools have been a necessity for the subprime and near prime space. There's a lot more value in the lift that you can get out of being able to separate the goods from the bads, especially if someone's been impacted, they've lost their job, they've gone through a bankruptcy. So you need to look at other sources to really figure out, hey, is this a good potential credit risk? But I see that trend moving up market, so to speak, in terms of the credit tiers. And there's a few reasons for that. We talked about equity, so better access to a larger population with some of these alternate data sources. We talked about frictionless lending, so that's another reason why there's interest in trying to pull in data that makes it easier to issue the loans with low risk. But I think the last is there's this idea of exclusion bias, right? So you can, or adverse selection, basically. So as other lenders start to leverage these tools, they're able to separate the goods from the bads better than lenders that are not. So it could, it will begin to have an adverse impact on lenders' lending portfolios if they don't start to adopt the new tools. I feel a shift happening that really hasn't happened for maybe 20 years, where there's excitement and the potential for gains from these new decision tools. And if you don't get on board and keep up, you could be left with the higher risk populations in your origination population.
Now, with all the right technology in place, how close do you think a credit union can get to 100% automated decisioning?
Yeah, ultimately, I don't see any reason why they couldn't get to 100%. I know that 100% is sort of extreme, but they should be able to get very close, because these new AI-based decision engines, there's two things. One is they have a lot more flexibility in how they deal with exceptions. So it's not really about ratios numbers. It's about being able to identify situations. Are they an existing member? Do they have any loans with these particular lenders that we know about? Are there special circumstances in their employment history? For example, you can see that potentially they used to have a well-paying job, and then there was a gap, and they're back to, they must have gotten a new job, right? You can see all that automatically in the data, where historically that would require an underwriter sitting down, looking at the details, talking through it, and saying, okay, well, looks like you're back on track, and it looks like this instrument could be a fit for you. All of that, I believe, can ultimately be automated. More importantly, the AI-based decisioning tools have the ability to learn. So even if there's a level of exceptions that are pushed out for manual review, ultimately, as the the underwriter knowledge worker makes those decisions and explains why, the tool can take in that input and train additional models that can help emulate that. So over time, your underwriters, the teams that really understand, the nature of the risk and the nature of your members and how you want to interact with your members, are incredibly important to the to every credit union. All these AI tools really do is they start to capture and emulate that expertise, automate the things that they can, so that there's a good frictionless experience and you can get higher volumes as needed. And it allows your knowledge workers, your underwriters, to raise the bar and look at additional ways to serve your members.
So the credit union has two teams that are primarily responsible for these things. There's the risk team and the IT team. What's your advice for making sure those two teams are working together for the common good of the credit union?
Yeah, I think there's a couple of things. Historically, I've seen this throw it over the fence sort of mentality between IT and the risk teams. And I don't think that was intentional. I think part of it was because their tools were so different. The IT teams are very focused on automation, kind of the workflow and the process around executing. And right now I'm talking about credit origination is sort of the topic, and this applies to servicing and all different aspects of where the risk or credit or member teams interact with the IT teams. But their tools are so different that there was this big disconnect between, when a risk team pulls data history and works with their, Excel or SAS or Python or whatever they're using to do their analysis, they get the analysis done, and then it's sort of, okay, now we have to get this scheduled to go push our strategy back into a production system. and it went through this big process. It was kind of thrown over the wall, just like old school software development, right? It's kind of these big stages. The tools are evolving where now the risk teams and the IT teams can work together on the same platforms. Same view of the data, same view of the logic. The risk team can run simulations and back tests and performance analysis on their strategies and the data that they have. And then that analysis can be pushed directly into a production system to run the real-time decisioning. And now you have a much tighter loop. The teams are working together. They're saying, hey, can you look at this model that we're looking at, or this data set? I want to look at these applications. Something doesn't seem right. They can have that interaction working in the same environment. And I think that naturally gets them to, start to work together more closely and collaborate more.
So let me ask you this: what a credit union buys into this 100%? They implement all this technology. What does that credit union look like compared to the typical credit union? What's different?
Yeah, I think the biggest difference is agility. I've been surprised. Some of these existing tools. Again, I was at FICO for 10 years and worked on many of these platforms back in the late 90s, and they really haven't changed that much in terms of flexibility, and it causes this fear of change. I've been amazed. For example, pricing tables. The way pricing is done across these tools is very rigid, and there's this whole process, often committees involved in trying to update pricing strategies. And how can you be agile if you have to go through all of that anytime you want to adjust how you might fine tune and create a more competitive offer for a potential member to bring them in into your community. So I think in the future it's going to be much easier to make change. And so two things. One is making those changes will just be part of the infrastructure. You shouldn't, if you're on the risk team and you want to adjust your pricing strategy, you can adjust it, and then you want to push it through a review or whatever, but there's no project to get that out. It's really just pushed out into the production system. The other is everything will be performance based. So, you have to look at performance before you make changes to your systems. And by having that natural environment that is continuously back testing for performance, it reduces risk, it reduces error, it reduces the need for a lot of double and triple checking. These very thick, model audit reports will be tremendously simplified. I mean, compliance will still be a big part of it, but it will be much more automated. So all that will result in agility, and then credit unions can be more personalized. They can interact with their members in a more flexible way. They can test new strategies, and they'll just be more performant.
Yeah, suppose I am a credit union that all this is new to me. Where do I get started? How do I educate myself? Where do I begin my due diligence to start moving down this path?
Yeah, I think it all starts with learning. Just understanding the technology that's out there, the techniques and technology, data. I take some meetings, right? That's a little self-serving as a vendor. It's always great to talk to new credit unions and teams, and sometimes it's just a exploratory conversation, but you'll learn as you have those conversations. And then you start to assess and create your own thoughts on how it could help your credit union. Every credit union is different, has different objectives, so you have to figure out how to fit those those technology and analytic puzzle pieces together. I also think you shouldn't be afraid to make some changes, and there's a cultural bias against if we don't change things much, it's not going to break anything. But I do believe the tools are and the techniques are getting better and better, so that you have that safety net. you can double check things. You can automatically check things before you release them. And in a way, you end up with a less risky situation by taking the leap and trying to move forward with some of these technologies.
I think you covered everything I wanted to talk about. You care to make some closing comments?
No, well, the main thing is working with credit unions has been a great experience for the Model Shop team. One thing we've found in this community is, you mentioned the IT teams and risk teams working together. Everyone rallies around a common goal for the member, and it makes it, to me, I think there's a great opportunity for innovation because of that. We kind of break through those traditional silos. So we're very excited to be part of this community. We're excited. We're actually, you mentioned earlier, we're going to be on the World Credit Union Conference stage in July together, you and I and Chris Hamilton, for the Chief Credit Officer from Golden One, and the dynamic has been amazing. So we're looking forward to helping more credit unions evolve.
All right. The name of the white paper is Innovation and Inclusion in AI Credit Risk Models. You can download that at www.modelshop.com. Thanks for being here today, Tom.
All right. Thanks, John.